Well, the world seemed to be talking about the stock market today, and for good reason. A lot of times when we become the topic du jour, it means that the stock market is crumbling, and indeed today was one of those types of days. We were down over 1% on most of the indices. In fact, over on the Russell 2000, we were down over 2%. However, this was not some sort of a massacre the way that the social media would have you believe. One of the trends on Twitter today was stock market crash, and I don't know if they were trying to be ironic or if people really felt like we were in a crash right now, but I can tell you this was most certainly not a crash. This is a normal, healthy market pullback. Many of us have experienced it many, many times in the past, and you better be used to it because you're going to experience it many, many times in the future if you hope to be an investor as well. So I don't make too much of it. Obviously, things had gotten a bit overheated for a while, particularly in some of those high growth areas, and they did get hit a little bit worse. But all in all, I think we're hanging in there just fine. So we'll take a look at all that, see what it means for our posture. Then we'll take a look at a trade application example where I wanted to focus on a dividend aristocrat company that has reached oversold levels where maybe we could sell a put to capture some income. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's March 4th, 2021. First of all, if you're new, welcome aboard. Remember to go over to YouTube, click subscribe on our channel, then go down to our description area and sign up for our email distribution list. We're also heavy users of Twitter, particularly on days like today. David and I happen to be a little bit more active when there's a little bit more chatter out there, so make sure you're following us. My handle is @BrandonVanZee. Really appreciate those of you that click like and retweet on these Market Outlook related tweets. And then last but not least, we do have a presence on Facebook. Feel free to join us at that web address you see in the logo in front of you. All right, let's go ahead and jump into the activity here for today. You can see that I've got the heat map pulled up here initially. Give us a sense of how much of a sell-off day it was, and it was a pretty aggressive day. We had mostly red on the board. This is the S&P 500 that we see in front of us. You can see some pretty ugly red patches out there. PayPal was down significantly. ServiceNow was down significantly. Of course, there's big old Tesla right there in the middle, which is a hot button item, it seems like, for a lot of folks. But notice how it's not all red. This was not a washout type of a day. You kind of have the tale of two cities. You got the left-hand side, which is filled up with red squares, and then you got the right-hand side where you have a lot more green kind of mixed in there. In fact, one of the things I was tweeting about today was the fact that energy didn't get hit at all. In fact, energy had a good day. You can see ExxonMobil was up nearly 4% today, and EOG was up 6% today. So energy was a place to be hiding out. In fact, yesterday in my factor-based swing trading class, we took a bullish energy trade, and that was up nicely today. In fact, both of the bullish trades that I presented to the group yesterday were both up over 2% here today. So there were places where you could find some bullish activity. You just had to be in the right patches of the market. Another area that did stand out to me that did a little bit better than might have been expected was some of those communication stocks. Notice that Google was actually up over 1% today. Facebook was up almost 1% today. AT&T was up almost 1% today. So a big chunk of that communications area, in addition to energy, and then a smattering of some of the financials and utilities, at least gave us some green out there. And so I think today's sell-off hurt a certain portion of the trader community, but it's mostly those focused on the high octane growth types of stocks that are out there. A lot of the more old line companies were still hanging in there just fine. Let's take a look at the advancers and decliners now. And so for that, I'm just going to switch this from a heat map to an index watch. And I've got the S&P 500 public watch list pulled up in front of us. And you can see that for every one advancer, there were 4 decliners, is the way that you can kind of think about that there. You had about 100 advancing stocks and 400 declining stocks. So again, it was not a complete washout type of a day, despite what the Twitter sphere would have you believe. Maybe I can take a step over there and show you that real quick. You can see here that on the on the right-hand side, they have some of these trends that are taking place on Twitter, and one of them is stock market crash. And, you don't have days where Google is up over 1% and ExxonMobil's up 4%, and that's not really a stock market crash. There might be a little bit of a stock market crash within certain segments of the market, but it certainly wasn't felt across the board. In fact, a lot of the more mundane dividend-oriented areas and value-oriented areas still held up reasonably well here today. While I'm over here on the internet, I always like to get a chance to say thank you to those of you that help support this market outlook presentation. I always strive to get at least 100 likes on my presentation. When I did it on Tuesday, when we did that bearish trade on NASDAQ, remember, we were already seeing the signs of the unraveling of the market a couple of days ago. So I'm glad we put that bearish trade on the NASDAQ 100 a couple of days ago. We had the benefit of the last 2 days of sell-off to help us with that particular trade. So if you like that trade setup or just enjoyed the analysis at all, we do appreciate those of you that click like for us there. So thank you to all of you out there that are doing that, Valerie and Deborah, and there's Anand. A special hello to Anand, who just joined us as a premium market scholar here in the last couple of days. So it's always great to have some new blood within our classrooms, and he showed up in my question and answer session earlier today. So it's good to get to know him. But Margie and Paul and Ram and Jorge and Lee and Jeanette and Phil and Ann and John and Larry, and there's a lot of them. Obviously, too many to rattle off there, but we see you. We appreciate you. Keep up the great work. If you want us to do these daily videos, we really appreciate that support. Also, while we're over here, I did do my question and answer session earlier today, as I mentioned a moment ago. Here were some of the topics we covered. Discussion of some of the new dividend increases from the prior month. Had a conversation about how to change some of the think script lines on my charts. Had a conversation about the champion spreadsheet and what the most recent percentage increase column is in regards to stocks like ALB. We had a question about ABM. We had a question about GCI. We had a question about some ETFs like MTUM. We had a question about how to add yield to a spreadsheet. We had a question about closing down some covered calls. And we had a question about how do we manage the trade, including that QQQ one that I did here a couple of days ago. Some of you might decide that you will close that trade down now that we've achieved more than 50% of our maximum gain on that. The last I checked, I think we had already achieved 70% of our maximum gain in just 2 days' time on that trade. So some of you might decide to exit a little bit early for our purposes here in this presentation. I'm just going to kind of hang on to it for right now as a partial hedge against some of our other bullish positions that we have. Also, I wanted to point out that last night I was able to put together, actually it was this morning, I was able to put together the dividend growth investing information from the month of February, and my oh my were there a lot of them. This is listed in our kind of popular recent posts, and remember, this is one of the things that we offer on our website that is completely free. So even for those of you that are not paying members of Market Scholars, if you want to see this information about the dividend increases, you're welcome to check that out. Once you click into this blog, you'll then be able to kind of expand that graphic there to see it a little bit better. As I kind of remind you right here, click the below image to enlarge it, and that'll pop up in another tab there for you, where you can see there were 120 stocks that raised their dividends last month that had at least 5 years of prior dividend increases. So quite a dramatic amount of companies coming to bat for shareholders and increasing shareholder pay. So if you want to check out that information, be my guest. All right, back on over here to the Thinkorswim platform. Also like to take a look at this chart whenever we have a big day, which is chart 6D. This will give us a sense of how exaggerated the movements were. Some of you saw me tweeting this chart out to Morgan Housel earlier today on Twitter as well, because I think a lot of us that have been around in the business long enough were a little bit surprised that everybody was making such a big deal out of today's activity. And, to me, it just simply wasn't a big deal at all. It might become one. I'm not here to say that it won't, but today was not anything out of the ordinary. Today was a 1% drop in the market. And yes, there were a couple of other indices that were down over 2%, but still, it really was not that big of a deal, particularly in light of what we just went through in the past year. you can see that this red bar right here follows yesterday's 1% sell-off as well. So understandably, back-to-back ugly sessions, and the day before that was pretty bad as well. So this is a third straight down day here. There's definitely a little bit of pain that's being felt, but all things considered, this is a pretty quiet period of time compared to what we went through just 1 year ago. This is March of last year. These red and green levels are showing us how exaggerated the day-to-day movements were in the market were back then. And today, in this era that we're at here in March of 2021, is nothing in comparison to what we went through in March of 2020. So, I think a lot of the chatter on social media today must have been from folks that were not trading or investing 1 year ago. And that's okay. We all got started somewhere, right? I actually got started investing in the beginning of the dot-com bubble. So, somewhat similar perhaps to some of these more bubblicious valuations that we're experiencing today. So, I survived that and everything that's come after that. So if you are somebody that's new, maybe you take some solace in that and understand that, yes, there's going to be some rough days along the way and you're going to question what it is that you're doing, but stick to it. It will benefit you over the long term, the more that you stay engaged in the market. And, those of you that have the commitment level not to give up on the market, that will generally reward you as time goes on. But just wanted to really make the case that today was not anything out of the ordinary. Today was a day like we've seen so many times in the past. And yes, there were some rough patches in certain segments of the market, but this is not anything remotely close to a stock market crash like was trending there on Twitter. One other thing I'll point out while we're over here, the VIX is at 28 right now. Even that is not an extreme reading. Just here a couple of days ago, we were higher than that. Not by much, but a little bit higher. So let me get this zoomed up here a little bit so we can see it a little bit better. Sometimes you have to rearrange these little pieces so we can see the information a bit better. So notice that where we ended today at 28 on the VIX was slightly lower than where we were trading just on February 25th. So again, there's not a tremendous amount of fear in the system if you're judging by the purchasing of put contracts and things like that. You can also see the VIX was higher here at the end of January. So again, the idea of this being a stock market crash is somewhat laughable to me. What I do like about seeing the VIX go higher is we are now getting opportunities to sell puts in high quality companies that maybe didn't exist when the VIX was lower. And again, that'll be kind of the idea behind my trade application example that I'll show you here after a little bit. So for me, I actually say bring it on whenever we see the VIX start coming a little bit higher than it had been in the past. It presents itself some opportunities along the way. But remember, the VIX got all the way up here to 40 when we were in the fall sell-off. And we were at 40 over here in June as well. And of course, reached all the way up here to about 80 in the heart of the coronavirus meltdown last March. So where we're at right now at 28, yeah, it's higher than where we were maybe a month or so ago, but we are certainly not at any sort of historical movements within the volatility index. Let's take a look now at our normal 4 grid. So this will be chart 4B for those of you that are premium members following along with your own charting package there. And this will be our 4 grid to look at the 4 major U.S. equity indices. And remember, when I was with you on Tuesday, we already knew at that point that our posture had gone bearish on all 4 of these charts. So today does not provide any new information from that perspective. We were bearish on all 4 of these charts on Tuesday. We remain bearish on all 4 of them here today. In fact, the shadings of the background colors hasn't changed in the last 2 or 3 days either. In other words, when I was with you on Tuesday, we were having the conversation that 3 out of our 4 charts had that light pink background color. And that light pink background color suggests that we have a weakly bearish posture, not a strongly bearish posture. One thing that I will say that is different, however, is that we now have these red moving averages associated with those 3. Remember, that was not the case on Tuesday. So while the posture has not changed, the placement of the candles versus the 30-day moving averages has changed. On Tuesday, we were still trading above the 30-day moving average. Today, we are no longer trading above the 30-day moving average. This is becoming a bit more concerning. remember I shared with you on Tuesday how I was already concerned about the NASDAQ, which is why we took the bearish trade on NASDAQ on Tuesday as my trade application example. I was worried that day and because the NASDAQ was showing me this tendency of it getting comfortable trading below the 30-day moving average. And I was fearful on this day that we were rejecting the possibility of blasting up and through that moving average, instead using it as an excuse to bounce down and away from the moving average. In other words, we stopped using it as a support bounce area and instead started using it as a resistance bounce down area. And so I couldn't make that commentary on the other three indices on Tuesday because that was not the setup at that time. But the fear now is that now that we have sliced through those indices, it's possible that the NASDAQ is going to do its best to drag down the rest of the market with it. Now, it might not be as aggressive, but nonetheless, it could start changing our mindset about the market to being a bit more bearish than we had been in the past. Remember, that's okay as well. The markets need to, as David always says, inhale and exhale. He had a good tweet about that here today. So this is par for the course. There's nothing wrong with what's happening here. If anything, what was wrong with the market is what happened late 2020 when the stock market was going to unbelievable valuations with some of the craziest growth stocks out there. You know, we saw things like Lucid Motors have a market cap of nearly $100 billion as it went from like $9 up to $60 and has now come back down to $20. We've seen all kinds of crazy things happen that is very abnormal. Of course, we all went through the GameStop saga and things like that. So what we saw there at the end of 2020, beginning of 2021, was the abnormal part. This pullback that we're experiencing right now is not abnormal. This happens throughout history. I don't remember if it was on Tuesday when I mentioned this or last week when I mentioned it, but I know I mentioned it here recently that the market normally goes down 10% from high to low at least one time per year on average. So this is not something that is like, okay, drop everything and we've got to stop investing in the market or something like that. This is a normal course of action for the stock market here. And by the way, we're not even 10% off the high for the S&P 500 at this point. We did hit that 10% level on the NASDAQ 100, but all these other indices, these are just normal pullbacks right here. So I think most of you have been able to handle this the right way. At least that's the goal of what we're trying to provide with our education. And I know some of you are not maybe as in tuned with what David and I do if you're only watching the free videos, but I at least hope those of you that are our paying members certainly understand that this is par for the course. This is not pull your hair out, panic, everybody run for the exits at once types of a moment. In fact, if anything, this is probably a moment to be looking for opportunity. Remember, the Fed remains highly accommodative. We are entering into a phase where commodities could very well start expanding. We might get a little inflation in the system, and that's not necessarily a bad thing. So I don't look at this as the start of some sort of a major disastrous meltdown for the market. Could happen, right? Anything could happen. There could be a bomb that goes off in the wrong part of the world tomorrow. But the way that I'm looking at this right now is I'm looking for opportunity. I think there's going to be good solid, high-quality companies that go on sale just like they do periodically, and it tends to be the case that throughout history, when you've been looking to take advantage of somebody else's panic on high-quality stocks, that has generally rewarded you as time has gone on, and that's kind of the mindset that I'm in right now. So I recognize, yes, we were long overdue for a pullback. There's been some pain in some of the more growthy areas of the market, and that's okay because those growthier areas received more gains than they deserved to lead up to this moment to now give back maybe more than they deserve as well. So, the market is equal opportunity, I guess, from that perspective. So as it stands right now, we do have bearish postures still, just like we did 2 days ago on all four of these charts. The NASDAQ composite is the one that's leading to the downside right now, so it's your biggest laggard. It continues to have a strongly bearish posture. In fact, we got awfully close to actually having an oversold cluster signal here today on the NASDAQ composite itself. And all four of our charts now have red moving averages in addition to their bearish postures, suggesting we now have price below falling moving averages. So this is something that could certainly take a bit of time to work itself out. But as I mentioned before, I'm not viewing this as some sort of a disastrous scenario. I think we're going to find ourselves a bottom. It might take a month or two. And along the way, we're going to look for those opportunities in those high quality stocks. Let's go ahead and take a look now at our next chart here. Let's take a look at the 3 green arrows chart. We might have a little bit of difference here compared to what we had on Tuesday. Let's see if that's the case, and indeed it is. Remember, on Tuesday, the NASDAQ was the only one that had 3 red arrows. The other 3 charts were kind of in neutral territory. Today, we can fast forward and now know that we do have 3 red arrows on all 4 of our charts. Actually, I take that back. Just glanced up there at the S&P 500 and I'm kind of surprised to see we actually received a green arrow on the stochastic for the S&P 500. So I don't want to read too much into that because that's about as weak of a phantom green arrow as you're going to find. That's about flat if I'm looking at it visually here, but technically there must be just a tiny itsy bitsy little improvement there that's hard to see with the naked eye that's being picked up by that arrow right there. So I guess we could leave the S&P 500 out of the conversation. Right now it does not have 3 red arrows, but the other 3 charts do. We received our 3rd red arrow on the Dow Jones Industrial Average here today as we closed below the moving average. Same thing can be said right here for the Russell 2000. And then the NASDAQ Composite, remember, it already had its 3 red arrow signal 2 days ago, and it continues to have it here today. Now, I didn't rattle off the returns earlier, so I should make a habit of doing that because I know some of you watch this on your phones while you're on your commutes. I saw Deborah chatting about that on Twitter, so great to see that you guys have some creative uses of your time. Those of you that pull this up on your YouTube apps on your phone and maybe walking the dog or what have you, but I know how hard it can be to see some of the information, so I'll try to verbally read that off when I think of it. The S&P 500 was down 1.34% today. The Dow Jones Industrial Average was down 1.11% today, so that was your relative winner. Remember, the mega caps are usually looked at as a little bit more of a safe place to be playing, so makes sense that they would go down the least on a day like today. The NASDAQ Composite was down 2.11%, and then the worst performer today was the Russell 2000, down 2.76%. So anyway, pretty ugly day across the board, but certainly nothing disastrous. Let's go ahead and now take a look at the longer term trends. And for this, we're going to look at chart 4C, and this will be our 1040 crossover method. Remember that this particular chart setup will give us a longer term view. These charts are 3 years in length instead of 3 months in length, and each one of the candles represents 1 week rather than 1 day. And so as we look at these setups here, what we are generally looking for is if we have any crossovers of the moving averages. Some of you have heard of the terms golden cross or death cross. And what we're using here is the 10-week moving average and the 40-week moving average. The orange lines are the 10-week moving averages. The blue lines are the 40-week moving averages. And you can see that the background colors of the charts change whenever we have a crossover of those moving averages itself. So back here in June of 2020, we had a golden cross as the orange line crossed up and through the blue line. Remember, the orange line is going to be more sensitive because it's only looking back over 10 periods. The blue line is going to be less sensitive because it's looking back and calculating averages over the last 40 periods. So when you see a burst of momentum or energy to the upside, eventually you'll get a bullish crossover. And that's what we received back here for the S&P 500 back in June. And we've retained that bullish longer-term posture ever since. Now, having said that, you can see that we've got some wear and tear on the chart. Today, or this week, I should say, we do have this red arrow that's showing up. Now, on this particular chart, that red arrow signifies a little bit of a warning signal. What it's telling us is that price is now below that 10-week moving average. We don't know if it's going to close there. That's the thing about weekly candles, which is why I typically only look at this chart on Thursdays. Even that's not a guarantee. You wouldn't know for certain until tomorrow afternoon. And David does a great job helping you guys out with that knowledge as well. But right now, if the markets were to close the week similar to where they closed today, we would have that red arrow stay on there. And it's basically saying that, hey, we've got enough wear and tear in the price action that we're now below the 10-week moving average. Now, obviously, we've got a long ways to go before we would close below the 40-week moving average, and even a longer time period before the 10-week moving average crosses the 40-week moving average. Because remember, there's a lagging effect that takes place. So when you see these little red arrows pop up, be careful with reading too much into them. Yes, they're giving you a heads up that there's a little bit more concern at this moment in time than there was previously, but it doesn't necessarily have to lead to any sort of disastrous scenario. In fact, case in point, you can see right here, we had a couple of instances where we had red arrows along the way in this bullish move. We had one right over here on September 14th, and then we had another one here on October 26th. And if you would have been a little bit too aggressive in your selling mindset to just liquidate your portfolio right here or right here, you of course would not have enjoyed this massive run that we've had through the fall and the winter to lead us up to where we're at right now. You can see along the way, we never did have any of those death crosses that took place where the orange line went through the blue line. We just simply had price action giving us a little bit of disturbance. Eventually we will. Remember, just like there are bull and bear markets, there will be golden crosses and death crosses. So it will happen at some point. It's just, I'm here to say that we don't have to make the assumption that it's going to happen just because we automatically got this red arrow all of a sudden. So we'll keep our eye on it, and as things change, we'll inform you of it, which is the whole point of us doing these videos every day. We get the benefit of seeing the activity change right before our eyes. And so we might not, catch the tops or the bottoms, but we're going to do our best to make sure that you learn this information sooner rather than later. A lot of times by the time, Joe Public finds out about a stock market sell-off, it's about the time that the stock market is about ready to bounce from those levels. And we would hope to find out that information sooner than that in a presentation like this where we're evaluating data every single day. Let's do some 12-grid analysis now. And we're going to take a look here first at the asset class 12 grid. And you can see here that as we pull this up, the background colors of the charts will tell us whether we have bullish or bearish postures using the intermediate line on the market forecast technical indicator. Some interesting price activity here today. First of all, as I mentioned on Tuesday, one of the big stories of the market right now happens to be what's going on with interest rates. It seems to be driving price activity. You can see interest rates surged yet again here today. Interest rates landed at 1.55% on the 10-year U.S. Treasury yield. You can see this was a pretty aggressive up candle. We're not at our highest levels on an intraday basis, but this was our highest closing yield going back since about a year ago. This is a 3-month chart here, but this is actually, we're at about 1-year highs approximately with the yields as it stands right now. And remember, for those of you that have been in this presentation for the last several months, this is not new information. How many times have I come into this presentation and told you guys, replace ticker symbol TNX with your favorite growth stock ticker symbol, and then look at this chart and then wipe the drool off your face, because we're all salivating on how wonderful this chart looks. It's a wonderful, wonderful looking chart. And when interest rates go higher, that tends to bode well for things like banks, brokers, insurance companies. And of course, that's where we've been focusing a lot of our activity, with our top-down trend trades and things like that lately. Whereas utilities and REITs struggle on a relative basis when we see that type of behavior. So anyway, that is a big, driver of market activity right now. Some people feel like with interest rates surging, this is not a great time to be in those growth stocks that did so well in a large chunk of 2020. You can see another big mover was the US dollar. A lot of times those two things do move in unison with one another, not always at an exact degree, but you can see that with today's surge in treasury yields, we also got a big surge in the dollar itself. Sometimes what happens is global investors will compare what's going on with the U.S. government bond yields and start transitioning their money into the U.S. markets to take advantage of that. And when they do that, they need to buy U.S. dollars, right? They need to sell euros and buy dollars in order to convert that into U.S. bonds where they can get paid those above average treasury yields. Remember, there are a lot of other governments around the world that do not provide as juicy of yields as we have in the United States. I know it's hard to say that when we have a 10-year treasury yield of 1.55%, but remember, like Buffett was saying in his annual letter over the weekend, there are certain areas in Japan and in Europe and elsewhere that actually had negative rates for a considerable period of time. So anyway, that might be playing a role here. As we see interest rates ticking higher, we might see more and more foreign buyers coming into the market. And in order to buy, they need to convert their home currency into U.S. dollars, and that helps support that movement into the dollar. We can also remind ourselves that the dollar is sometimes used as a safety area, a safety valve of sorts when market participants are confused or nervous. Sometimes they just liquidate their stock and bond holdings altogether and just move into cash, and that helps support the dollar as well. Remember, when the dollar is strong, that tends to bode ill for commodities. And once again, gold was down. Gold was down almost 1% today, a fresh 3-month low for gold prices. However, like I mentioned on Tuesday, oil has been an absolute superstar. Some of you heard me say on Tuesday, even though we had 4 straight down days for oil, this would be a chart I would be looking to buy, not to sell. And that's exactly what has happened. The last 2 days, oil has surged. In fact, we went to a 3-month high on oil here today. And we'll talk about the sector performance here in just a moment. But oil and gas stocks did tremendously well here today as a result of what we see here on oil prices. So they're on their own trajectory right now. They're not acting as just a generic commodity that reacts to the U.S. dollar movement. They have their own plans right now, and oil is certainly in favor. You can see that the strong U.S. dollar did have the impact of selling off the emerging markets once again. Remember, that was a similar conversation I had with you on Tuesday as well, where we had the dollar impacting the foreign markets. Here we see emerging markets are now at basically, let's call it a 2-month low, something like that, and it's becoming more and more concerning. I compared this to the NASDAQ 100 on Tuesday, and I continue to think in those terms. In other words, both of them attract growthier types of investors, both of them currently using the 30-day moving average as a resistance area, both of them having a strongly bearish posture right now. So right now, we're kind of looking at this, getting a little bit more nervous. There's a little bit of a head and shoulders pattern that's developing there for the emerging markets. So we were down over 2% on EEM today, a pretty ugly response there. Bitcoin was down 5% today, but as you can see, this one is such a wild performer here that even a 5% move is almost like you got to squint to even see it on the chart. It's almost like a nothing burger there. We continue to trade easily above a rising moving average. So far, Bitcoin has not had a meltdown effect along with the NASDAQ 100 types of stocks out there. I think that is a good sign for those of you that enjoy your cryptocurrency. I think that's a positive development that, we are seeing some extreme volatility with growth-oriented assets, and Bitcoin has kind of held in there like a champ so far. Let's take a look at the sectors now, and the sectors are going to be chart 5C. And the one I wanted to highlight is the chart all the way over here to the right-hand side. This is your energy ETF. So these will be all of your oil and gas stocks, your Chevrons and Exxons of the world, and EOGs and all those types of companies. Well, anyway, XLE was up over 2% today. Think about that. This was a day when some people were claiming we were in some sort of a stock market crash, which of course is not true, but some people claimed it nonetheless. And on that day, oil and gas stocks were up over 2% on average, with some of them up even greater than that. So anyway, energy continues to be a stellar performer. And remember what I shared with you on Tuesday. We already knew from the sector selector rankings that I put together last weekend that energy was number one. So strength begets more strength in this particular case. I would also point out that the financials outperformed the market in general. Yes, they were down over 1%, but slightly outperformed the market today. That's another area that has been quite hot. Remember, the value category contains a lot of financials and a lot of oil and gas companies. Also, I was impressed with what I saw out of the communications, and that's what I had mentioned earlier when we were looking at Google and Facebook and AT&T. Those types of stocks did hold up really well today. They were actually only down 0.18%, so communications was rather impressive today. What I didn't like seeing today was what happened with technology. Remember what I said on Tuesday? I said my hope is that technology can find some stability here because I'm fearful that it's going to turn into consumer discretionary. Remember on Tuesday we knew that consumer discretionary was already rolling over. What we knew about technology is that it had just closed below the moving average. Well, I think we've got some more evidence here that that's just not in the cards. Technology is in a bit more of a meltdown type of a mode right here. 3 straight days. Now look how far away we are from the moving average, which has just turned red. Now, some of this is as a result of damage to some of the bigger names out there. One of the things I shared on Twitter yesterday was that something like discretionary is holding up much better on a small and mid-cap basis. Where we're seeing aggressive selling is in the Teslas and the Amazons of the world. So remember, you can come over here in our chart package, and if you come over here to, where is it? The ratios. There it is, 1H. If you click on ticker symbol, or not ticker symbol, but chart 1H, you can kind of see that activity. And if you look over here to the left-hand side, this is your equal weight discretionary divided by market cap weight discretionary. What this is telling us with this huge surge right here is that the small and mid-cap discretionary stocks are holding up so much better than the mega caps like your Amazons and your Home Depots and your Teslas. XLY is getting crushed right now, but you wouldn't necessarily notice it if you went through and picked through all of the individual components of the consumer discretionary space. It's just that the market cap weighted version of it is taking the brunt of the selling right now. And you can make the same claim here really with technology, communications, and real estate as well. All of them are kind of giving us that impression that the small and mid-cap areas are holding up better than the larger companies within those specific sectors. All right, let's get into our trade application example now. And for that, I'm just going to pull up chart 2A. This is our dividend stair-step chart. So this is what I use oftentimes in my Tuesday morning dividend growth investing class and also in my Monday afternoon options for long-term investors class. And the stock I wanted to bring up is Kimberly-Clark. Now, the reason I selected this one here today, it was really a toss-up. I was going back and forth between this one and Home Depot, so I think they both kind of have some appeal here from a sold-put perspective. The reason I chose to go with Kimberly-Clark in the end is that Home Depot did not have an oversold cluster signal on the weekly candle chart, so it is coming down here and starting to approach some of this blue area. If we get down into that blue area, I think it can become an attractive pickup for the long-term perspective. So selling a put at around 225 could make a lot of sense right here. But with Kimberly-Clark, which is the trade I actually did, and remember, I've already done the trade. Trade was done about a half an hour before the market closed and sent that out via Telegram, as I always do to those of you that are premium members to give you a heads up before everybody else. But the reason I ended up going with Kimberly-Clark in this case is kind of like Home Depot. It's pulled back significantly here in recent weeks and months, and it's starting to approach this blue line again. And that blue line is where we want to pick this up for long-term investing purposes. You can see, had you bought Kimberly-Clark back here in the blue area, you'd have been pretty happy about that. Had you bought it over here in the blue area, you're pretty happy about that. Again, here in the coronavirus meltdown, when it crossed that blue line, you're pretty happy if you picked it up at those levels. So we're kind of getting close to that level once again. That level is around 120. So that is actually the strike that I sold in the month of April. If you need the specific execution price and the fill prices on that, check your Telegram. But with a nice round number like 120, that means that an options contract is available for us to sell there. In this case, I'm selling a put. For those of you that are newer to that concept, what that means is I'm not willing to buy the stock right here, right now. But if it continues to fall, I want to put myself on the hook for buying the stock at 120. In the meantime, I get to collect premium up front, so I make money when I sell that put to begin the trade. Now I'm on the hook for buying the share, so I'm taking off. I'm taking on somebody else's risk. that might be buying the put. Somebody else is buying a put because they might think the stock is going to continue to fall. I'm willing to sell the put because I'm saying to myself, I think buying Kimberly-Clark at $120 is a pretty attractive undertaking. Remember, Kimberly-Clark is a company that's raised its dividends for approximately a half a century. It's on the Dividend Aristocrat list. It makes things as mundane as Kleenexes and toilet paper and different things like that, which shouldn't fall too far out of favor even if the stock market continues to sell off. So what really was attractive to me about this one is the fact that we've been getting these cluster signals right here. These green little dots show up when we get oversold cluster signals on the weekly candle charts. And remember, those are even more rare than cluster signals on a daily candle chart. So I'm kind of getting the impression that while we might not be done selling off in this particular stock, I think the sell-off is going to become less aggressive as time goes on. And therefore, we might start bottoming out between here and $120, which is why I sold that $120 put for the month of April. So we'll see how that goes as we maybe start kind of trying to transition to some of the more higher quality and maybe more defensive names like Kimberly-Clark, as some of the growth-oriented areas are getting beat up a little bit more here in this current market environment. So that's what I had for you here tonight. A little bit of a longer video, but naturally when we have a big down day like we did today, there's a little bit more to talk about. So hopefully you guys enjoyed that evaluation there. If you did, I have one favor to ask of you, which is simply to click like for me there on Twitter. And there's 4 different ways you can go about that to make it nice and easy for you. If you click like and we continue to get good support of this video, we'll do our best to continue to produce it for you on a regular basis. So with that, I'm going to assume that David will be back with you here tomorrow, and I'll see you guys all early next week. So with that, have yourself a great rest of the night and best of success with your trades and your investments. Goodbye for now.